Well, hello and welcome back to Master Horn Investing. This is Brian Horn. Thanks for joining me today. Today we're going to be talking a little bit about like dividend growth stocks, or something that's less volatile, pays dividends, and more of a steady grower. So it's not just going to be like a high flyer. So in this time when the markets are more volatile, we might be looking for stocks that pay dividends, can grow the dividends, where the company is more likely to continue on growing, maybe grows 5 to 10% a year, 15% a year, and doesn't have the downside risk of many of the tech stocks. So what I'm looking at today is Phillips 66, symbol PSX. So we want to look at refiners, because refiners can make money regardless of the price of oil or regardless of the supply of oil. Refiners can take even used French fry oil from like McDonald's and turn it into diesel fuel. Supply and demand says that refineries will make a lot of money. Price growth of the fund or the stock looks to be maybe 10 to 15% a year, in addition to a 4% annualized dividend. And even Phillips 66 is talking about buying back more of their shares. They got so much cash, they want to buy back more shares. Well, that helps boost the price. It also then reduces the outstanding number of shares. And then as they make money, the dividend grows. So you have a price growth potential, a dividend growth potential in a more stable, less volatile, less risky, stock than say a growth stock like Tesla or Google or Amazon. So here's the kind of the summary. The summary would be to buy Phillips 66, probably at 102 or better if you can. But even then, I mean, if it was 105, it'd still be a good growth stock. Yes, you might grow a little bit more if you can buy it at 100 or 98, but it's still in an area that's a good time to buy. So I saw a presentation from Jeff Brown with Brownstone Research, and Jeff Brown's probably one of the better research papers that I find. He does stuff on like these new companies before they get to venture capital that then later go public. He calls it his day one investors. He's got stuff he does on biotech, other stuff on a near future report. He's got some great research. Out of all the research papers I get, he's probably one of the best ones, most diversified, more accurate, and great ideas. So he did a presentation on Phillips 66. So I'm kind of using some of Jeff Brown's ideas here. So we're looking at gas prices. So if you wanted to subscribe to Jeff Brown, I'd recommend that. So gas prices are likely to remain high for years, not because because oil cartels are cutting production and keeping prices up. And it's not just because there's some greedy oil company out there charging more for their liquid gold. The price of a barrel of oil is just one of the factors that goes into the price of gas. There's not a shortage of oil. That's not the problem. The problem is we have a shortage of refining capacity. We can't refine the stuff fast enough. If we had more refineries, we could be pumping out gas a lot faster, and the gas prices probably be half of what they are now. So the process of taking crude and turning it into petroleum products that we depend on every day is this refining process. That's why we like Phillips 66. It's not going away. It's not going anywhere. They have to have this. Now we're going to have a fuller explanation below here, but we just want to understand that this here's where the bottleneck is. So we got a demand issue for refineries, and that demand keeps the price up and keeps the dividends high. Petroleum in the U.S., these oil refineries are at maximum capacity, and we can't produce any more gasoline than we have. And even if the price of oil goes down, you still can't produce it any faster. So the solution is simple. Well, yeah, build more refineries. That'd be the easy thing. The problem is Congress and the governments have put so much burdensome issues on refineries, and the green movement and pollution and everything they're saying, that no one is going to invest any money into building a refinery. First of all, it takes billions of dollars. Second of all, it takes years to do. So that no for-profit company is going to make that kind of an investment. Well, so what happens then, and it comes down, it's not even more of a surprise because how much stuff comes from petroleum. We have clothes, we have soaps, deodorants, paint, insect repellent, vitamin capsules. We have all sorts of stuff, that bandages and makeup and golf balls all have petroleum products in them, and they all have to be refined. So our modern lifestyles, the way we know it, would cease to exist if we stopped drilling and refining oil. So anybody thinks that it's just going to be a green movement, we're going to stop oil, and there's not going to be any more oil, you're in la la land, at least for the next 50 years. Because of this, petroleum is not going to go anywhere. So we have to have it for all of these products. And the demand for oil is not peaked. We're still growing reasons for having oil. We just got more plastics and more clothes and more things. So even though there's been this push for green energy and efforts towards renewable fuels, the demand for refined petroleum products has actually increased. So now this is from the Brownstone Research here, you can see, because this is their chart. So you can see that basically what's going on with oil demand. Well, you have ethanol. You can see these kind of different things down here at the bottom that make up each one of these bar graphs. And we're going to look at 2020 here out to 2045. So we're looking at another 25 years. I mean, demand is still rising. It's not decreasing for these oil products. So the BP, British Petroleum, BP, they're the big oil conglomerate. They just recently released their annual energy forecast. Now we're going to look at these transportation numbers. About 75% of transportation is oil demand. And BP says that shows out to 2030, still all jets will run on petroleum, jet fuel. Light and heavy vehicles, boats, cruise ships, ocean liners, everything. They're all going to be using byproducts of petroleum, not renewable energy from like electricity or something. I mean, like solar or something. So here's the kind of thing. There's no, until 2050, there's no significant drop in the demand for oil. So you can see out here at 2050, these byproducts of the oil stuff, yeah, they kind of start to decline. You see, you drop a little bit to the 40, and then you got a little bit of a drop down to the 50. But there's not really a demand drop for another 20 to 30 years, and even then you still need it. So people will still be refining oil. Now, what about electric vehicles? Well, there's this big push, but it's going to take decades to replace any of the current engines we have. I mean, how many cars are on the road that from like 1990, I mean, like 30 some odd years ago, and they're still running? Okay, so it takes a while for people to kind of run out their own old cars. So there'll still be demand for that. And in addition, the making of the batteries is not as easy, and a lot of that even requires a lot of oil and fuel to run all the big trucks and the mining equipment and the companies that make, extract all the lithium and the nickel and so forth to make these batteries. They're all running on oil and gas anyway. So let's look at the capacity now. So this is the refining capacity. Well, how much capacity is there to refine oil? Well, if we look back to 1913, we were at 17.8. And by 2022, 17.9. I mean, the capacity is not really increased. So we have had an increasing demand, but the capacity is actually went up a little bit, came back down. It's actually on the decrease right now. So we have actually a decreased capacity with an increased demand. Oh boy, that's right. That's a supply-demand issue that's completely in our favor with this stock. So how about countries that are closing? That's just the U.S., the one we just looked at. How about look at countries around the world? New Zealand closing 100% of their refineries. They're not going to be refining. South Africa down 58%. Australia down 50%. Philippines down 40%. Norway down 35%. And I mean, you can see it all the way down here. Everybody's reducing capacity, not increasing capacity. So nobody's building a new refinery, but they're closing some. That means there's less refinery capacities around the world. So now we have the green movement, which is pushing or increasing refinery profits. And the reason is this. There's the big push for renewable diesel. It's not really renewable in the sense like solar or something like that. It's renewable because it can take other things such as soybean, canola oil, even oil that's already been used for deep fried foods like French fries, animal fats, and turn it into diesel. And this diesel is elementary similar to regular diesel derived from petroleum. So, for example, a smaller refinery, I'm out in Utah here, Sinclair converted a 52,000 barrel per day oil refinery into a 6,000 barrel per day renewable diesel refinery. So that takes all that off the table. The difference is they can actually make more money because of all these incentives and so forth, they can make more money producing 6,000 barrels per day on the renewable side than they can at 52,000 barrels per day on the oil side. So even though they have this lower outputs, refiners are economically incentivized to convert these refineries. So with the policy incentives involved, these refineries can make a 30 to 40% annual return on investment. So Phillips 66 is kind of a cash cow here. Brownstone Research points out that Phillips 66 is in full cash return mode right now. Basically, they're returning profits to the shareholders in forms of dividends and share buybacks. Share buybacks tend to push the price up early and hold it up. So they spent $3.8 billion acquiring outstanding shares last year. They had enough cash on top of that to maintain their debt target of 30%. Now they plan to keep that low and actually put more money back into shareholder capital. So if you look over the last 10 years, Phillips has increased their dividend payment from $1.33 a share to $3.83 a share. That's an 18% annual growth rate on the dividend. And then at current prices, that's about a 4% yield. Management plans to buy back 10 to 12 billion more of outstanding shares up through this year and next year. So that's like at a higher rate. So last year they did 3.8 billion. If they did 3.8 billion this year and next year, that'd be what, 7.6? Well, they plan on almost doubling that, or at least going up 50%. So they want to buy back about 20% of the entire company. That's going to be pushing the share price higher, at least it generally should. So according to Brownstone Research, the company's in current rock bottom valuation. It has an EBITDA of 5.4 times, and that's the lowest it's ever traded at, that kind of an EBITDA. An EBITDA is earnings before income tax and these other kinds of things. So it's kind of like it's a valuation. It's a way to kind of figure out what the company's worth before tax. So since the start of all this, the EBITDA per share, if you look back if you look at 2022, it made $11.1 billion in EBITDA. So this earning before income tax and other depreciation things. So with the on a 473 million shares outstanding, well, if they're going to be buying back shares, then they're going to have less shares outstanding, and so that should actually even go up. So let's say the EBITDA grows by 3 billion as management projects, and the share count reduces 20% like they talked about over the next 2 years. We will have 14.1 billion in EBITDA to spread out over fewer shares. So 379 million shares. And that's about a 37.24 EBITDA per share versus the current 5.4. So assuming that the stock trades at 4.5 times multiples today, and the price, that would show that we'd have a price in a few years of 168, where it's currently trading around 100, 102. It's kind of bouncing around there. So in just a couple of years, it could have a 69% gain from the current price, on top of getting those dividends of 4% a year. So this is an excellent way if you have an account and you don't like volatility and you just want something that's kind of stable, steady growth fund, gets the dividends, and maybe you're considering pulling your money out of the market because you want to stick it in a fixed annuity that's paying like 5, or a bank CD or something paying 4.5. Well, here you can get a 4% dividend and have a very good opportunity for some growth with very little downside risk, because regardless of what the stock market does, almost regardless of what the economy does, we still have to produce this oil, and we have to still have to refine all this oil into stuff that's not even just related to cars. Like we talked about, it's clothes and foods and vitamin capsules and just on and on. It's just all these things it gets refined into. It touches so many facets of our life. I mean, yes, if we were in a Great Depression, yes, you might see some stuff like that. This has got to be one of the safer investments that you can make in stocks with the dividend, but still have some good growth potential, outperforming the average 10% a year return you expect to make in a mutual fund. Okay, I hope that gives you some ideas for an additional investment, something that's not a high flyer, a little more stable, steady, consistent, paying dividends, good long-term hold, great option for your trust account, or if you just want to own stocks and leave them to your kids, or just get dividends and still have the account grow and so forth. And if you like this, go ahead and hit the like button. If you like what you see, go ahead and hit the subscribe button. And then when I post future videos, you'll be able to get notification of those. And you have a great day.